Just waiting to get confirmation that we are up and running. Welcome. We're doing a live stream here. I thought I would do this one on micro futures. I've had a lot of fun lately trading the micro futures. And if you don't know what the micro futures are, well, first of all, what are futures contracts? Futures contracts are leveraged way to trade commodities. Commodities are uniform assets. So very common would be like crude oil, gold, silver, currencies. And they started out when farmers needed to hedge crops. That's how futures started. Nowadays, they are still used for that. You can sell your future crop using a contract. But because they are leveraged, if you're not a hedger, if you're a trader or a speculator, you might use a futures contract to get more buying power or to get trading overnight, maybe, because futures trade almost 24 hours. It's like 23 and a half hours a day. They open on Sunday night. A lot of reasons why you might want to trade futures. Very risky because you're allowed to trade a lot of value for not a lot of money. So these contracts that I'm looking at here, they're called micros, and they're newer contracts, at least for me. They're smaller contracts. And in this case, I'm going to start off with the micro because I'm doing a lot of micro Russell trading. The micro Russell, you're controlling 5 times the index. So it's every 1 point, which is 1.00, is worth $5, which means this is a little more than 10,000 bucks. Like if I do just a quick, if I multiply this by 5, $10,482. So this, the way I have it here now, I multiply it by 5, you get a better idea of what we're actually trading. Now, in order to trade this $10,000 worth of risk, whether you're bullish or bearish, if you think it's going to go up or down, you're only required to put a down payment. So what happens is a lot of day traders or swing traders or professional traders, they'll use futures just like this one or the mini or the bigger contract. And they like that because they can get 10 times leverage or sometimes more intraday. Day traders might even get 40 times leverage, even more if you're trading something like bonds. But I'm going to focus specifically on the micros, the E-mini, and the Russell 2000, just because I don't usually trade futures so much. I trade options. I've traded options on futures, but I'm really enjoying working on my system. It's a very interesting way to try to make a little daily income, keep you engaged in the market. And because they're smaller contracts, you can keep your trades very small. As long as you use a stop loss, as long as you have a take profit, very interesting way to trade. And so we've covered that the value of the contract is about 10,480, and it will fluctuate. In November, the contract was smaller. It was around $8,400, and now it's a bigger contract because the market went up. If we look at the margin rates, now I'm looking at TradeStation. They have their margins here listed, so it's very easy to use. If we look at the mini Russell 2000, actually that's the bigger contract. The bigger contract is $50 a point, and the overnight, because I like to hold stuff overnight versus day trading, this is $7,000 to put it on. Because we're using the micro, that's this one down here, the M2k. That one is $700 to put on, $715. Once you put on the contract, you have a maintenance margin, which is a little less. So to put it on, you have to have $715 in your account to keep it on, they give you a little bit of a break, 650. And that this every broker can have their own margins. This is TradeStation's margins for conversation, entertainment, education purposes. I'm using them. For day trade, if you have a tight stop, you can actually use less money. So what's fascinating is I'm an option seller. Personally, I like to either sell options or own stock or own long-term leaps, like 1 year call options, for example, in the money, as conservative as I can. But I've had a blast trading the futures. I trade with a bias, and it's very interesting. And so I'm just going to share some of my findings. So 715 to put it on. And then since we know how much it takes to put on, you have to think about what's the strategy. Are you going to be doing a swing strategy? I don't like the futures so much for swing trading for a long period because I feel like the options do a better job and I have more staying power, because if I'm wrong, I'm going to get stopped out. So going for a shorter term trading style seems to work better for me when I'm trading the futures and the micros. And if you look at today, really there was two major moves. If you were bullish, you would have gotten bullish. But let's say you got most of the move. It looks like it maybe 20 points. There was a 20-point move to the upside and maybe roughly another 20-point move to the downside. So what does that mean? It means that 20 points up if you were bullish and you caught it perfect, 20 times 5 is $100. And then if you were a bear at the right time, just happened to be a bear at the right time and it dropped 20 points, that would be another $100. Now, maybe that's a lot of money to you. Maybe it's not. But you got to remember, let's say it's $100 per day or in one day, and you only have to put up 715. Well, that's a pretty big return because it's leveraged. Now, risk and reward is two-sided. So if you're short at the wrong time and you don't have a stop, you're gonna lose $100. And that's just the way it goes. You really have to have a system and a strategy in place. But from a capital efficiency standpoint, it's a very interesting proposition. If you were just to trade during trading hours, for me it's 6:30 to about 1. You get a reduction in buying power. So the micro Russell, it could be 179. They give you a day trading bump or a discount. So if you make $100 or $200 trading correctly, you may only have to use that much money if you're trading intraday. So it really gives people who trade or are willing to put in the work and sit in front of the computer and the monitor, gives you a chance to efficiently trade and try to make daily income. Now, very hard to do, but futures do give you the buying power and the capital efficiency to try to do it. Now let's see, MES. We'll just cover MES. Oops. Let's do M 2024. So this is the S&P Micro E-mini. This one is also $5 because it's 1/10 the mini. The mini is $50. And then we'll look at the margin. So because it's probably about $25,000 worth of nominal. It's called nominal. It would be like trading $25,000 worth of S&P. So the margin's going to be more. If we go to the micro ES, it's almost double. So the micro Russell was about 10,400 bucks. The micro ES is about twice that, so it makes sense that the margin's around $1,200. It's $12.98. If you trade intraday, it's even more attractive than the micro. So kind of interesting that it's so low. Must be a popular product. They must be doing it because they know a lot of people are interested. And is there anything else? Yeah, okay. So another thing to point out is when you are trading futures, you have to keep in mind what month you're trading. Like recently, we went from the March to the June, and the last week you want to stop trading the near date and go to the further back month, which would be the, in this case, you stop trading the H and you go to the M. So every 3 months, you're going to be switching contracts. Let me go back to my favorite, the M2k M. Like if you look M2k, let me just put M2k, it'll give me different months. So we have the H, which is expiring this week. You have the M, which is now the active, the more active, more popular contract, and it will be that way until we go to 1 week left in the contract, and then everybody will run to the September. After that, it'll be December, and then the whole cycle repeats for the next year. Just something to keep note. Eventually, it just gets harder to trade in the last week, and then you won't be able to trade it at all. Anything else? I'll just give some thoughts that I found. M2k M 2024. So I like to trade inside moves. Me specifically, I like to trade inside moves. So an inside move would be like a breakout that doesn't break out and fails, and then it drops. This would be an example of an inside move because it stayed within the range. It didn't break out in either direction. It just stayed inside. Another style would be to trade breakouts, like maybe breakout 2094. That would have been a bullish signal. I don't like to trade that way, especially right now because I have a bias. I have a bear bias, so I'm looking to trade to the downside. And one of the reasons I love this is I choose my trades, I choose my risk. I can put a stop market. Stop market is an order that pulls me into the market. It's like you set a level. In this example, like if I put a stop market at 2094, if it hits my level, it gets me short, and that's the type of trade I want to put on. If that doesn't make sense, another way to say it is if I wanted to be bullish the market, I can place a buy stop above the market. It only triggers if the market is showing strength and rising. So if the market starts to go through my level, once it triggers, I'll get pulled in. And the reason that's a good way to trade, in my opinion, is that if the market does what you think it's going to do, then you get pulled in. But if the market instead never goes up, let's say it never goes to my level and it just sinks, well, then I'm not in the trade. So it reduces my risk, in my opinion, because statistically speaking, my trades that are winning will be my order will be triggered when the market is moving in the direction I think will happen, and I will avoid all the losers that never start rising. So do with that what you will. One more interesting mention would be that it's better to take smaller profits based on the range of the market. So like if you look, this is the 4-hour. It seems to chop around in a certain range. Now, and some people like to plot an average true range, but you can intuitively just look. It seems to keep chopping around. What is that? Like if we measure high to low, 100 points, 80 points, 68 points. So it would somewhere around 60, 70 points is the max that I would expect. So I would want to decide to trade within that range. Like I'm not gonna put a short at the high level here. Whoops, that's in the way. I'm not gonna place a short and place a take profit limit way out because most likely it will just hit somewhere, between 160 points. At least that's how it's been moving until things change. You want to keep that in mind if you're trading for income. If you're trading for a crash, maybe you might do some put spreads. Futures, from my experience, haven't been the best way to try to trade those bigger thesis ideas. They're more of like an income generator type trade for me. Anything else? Oh, also the 20-day or the shorter period moving averages have been quite useful for me. I'm noticing that they do seem to respect like the 20 and the 10 to 20 moving averages seem to be respected as long as if we're in a bullish move, we tend to stay above that. So it would be useful to keep that on your chart. Like when it dipped below the 20 period average, it didn't continue, it recouped the moving average. And right now we're trading above the 20 period moving averages. But when the market is falling, like let's look at RTY because it has more trading days. If we look at, let me see, in a downtrend, it stays below the 20 period moving average. In an uptrend, it tends to stay above the 20 period moving average. So it doesn't work perfectly, as you can see, but generally speaking, it's nice to have those because they become self-fulfilling. And like here, I would be worried about being too aggressive on the short side because we're above the 20 period moving average. But if we started to create a downtrend, then I could be trading bear trades with a bear trend. I think that's all I have for now. Didn't want to make the video too long, but if you have a question on the micros, on the minis, or even the futures options, I'm happy to have a conversation, and maybe I'll make another video as a follow-up based on your comments. Thanks for watching.